Hello and welcome to the Tax Roundup for July, and Happy New Financial Year. What a mad month it's been in June, with a huge amount of change for advisors to get their head around. First up, Rae is going to take you through the key legislation that's either passed through Parliament or in Parliament. These are the issues all your clients are asking about.
June was a very busy month in Parliament, bedding down a lot of the announcements from the budget that are now in bills we can actually talk about. So today we're going to go through three of the key bills that all advisors need to know, because these are the things your clients are going to be asking about. Now, Tax Laws Amendment, Small Business Measures number 1, covers off the reduction in the company tax rate from 30% to 28.5%. And this is effective from the 1st of July 2015. So there's some relief for the small business entity companies. It is important to note, though, that although there's a change in the tax that's now imposed from the 2016 year onward, there is no change to the franking credit rate. That is still 30%, so the companies can still frank to 30%, even though they're only paying tax at 28.5%. Good news for companies that have a nice, healthy franking account balance. Tax and Super Laws Amendment number 3. This has 3 components. It's currently before the Senate, but there are some interesting points to go through. So the first one is about the small business income tax offset for unincorporated entities. Still all applies to small business entities, but if, for example, you have a trust, the trust is running a business, and that income is going to flow through to an individual. That individual will be eligible to claim this offset, which is capped at $1,000 and is effective from the 2016 tax year. Okay. It is very important to know, however, there is a specific carve-out for personal services income. So where there is PSI being generated through the unincorporated entity, and that is either being paid out of salary wages or attributed to the individual, they will not qualify for this tax offset. The second measure that we're going to be talking about is the rather generous immediate deductions for starting a business. There are immediate deductions available for the cost of advice in relation to structuring the business and initially setting it up, and also to government fees and charges that would apply to establishing that business. It doesn't apply to other formation costs, but at least we know that when they're starting the business and they're getting the right advice from you, that they will be able to claim a deduction for it. Now, the third measure is in relation to FBT. That will only take effect from the 2017 FBT year, unlike the other 2 measures which take effect from the 2016 income tax year. The FBT relief for small business entities is in relation to the provision of electronic devices. As you know, many employees might like to have a mobile phone, a tablet, a laptop, and up until now they've had to choose one because the employer can only provide one a year with the FBT exemption. Otherwise, FBT will be payable. Going forward from the 2016-17 FBT year, a small business entity employer will be able to provide more than one of these devices, and they would still qualify as an exempt fringe benefit, even if the devices have broadly similar functionality. So good news there for employers. Tax Laws Amendment, Small Business Measures number 2 is the one we're waiting for in relation to the accelerated depreciation. Okay, so this is where the taxpayer has incurred expenditure after budget night, 12th of May 2015, after 7:30 p.m, that relates to an asset they're going to be using in the business. Now, a key point to remember, the taxpayer that wants to claim this has to be a small business entity. So please don't forget the aggregated turnover test. Are there any other related entities that's going to tip them over into not being an SBE? Key point to remember there. Assuming that they are an SBE, they can claim the deduction for the business asset that they have now acquired for $20,000 or less. Now, another point to remember, if this taxpayer is eligible to claim GST, the cost is the GST exclusive cost of that asset. An important point to note. In addition, this bill also introduced the measures for primary producers. So that's where they can deduct fodder storage assets over 3 years and also water facilities and fences. So if you have a taxpayer that is an SBE and also a primary producer, they have the choice. They can pick whichever of these measures is going to be the most effective for that particular taxpayer.
From the ATO this month, Michael Carruthers takes you through a draft determination and a draft tax ruling, both looking at unpaid entitlements of trusts and the implications of those.
Well, the first piece of ATO guidance that we'll be looking at today is a ruling, a draft ruling, TR 2015/D2. Now, this is a ruling that hopefully will clarify a bit of an issue that we've been seeing come up a fair bit with the small business CGT concessions. So as many of you would know, one of the tests that we often need to look at for the small business CGT concessions is the $6 million net asset value test. And a particular issue that can arise often is unpaid distributions that are owed by a trust to a beneficiary. How are they taken into account when it comes to applying that test? Now, in this draft ruling, the ATO looks at it both from the point of view of the beneficiary as well as from the trust itself. Starting with the beneficiary, the ATO confirms that that unpaid entitlement that is owed to the beneficiary is an asset that should be included for the purposes of that beneficiary's net asset value test. Now, whether that's an individual or a company really shouldn't matter. The ATO is saying that that entitlement to that distribution is an asset. Its value, its market value, should be included in the $6 million net asset value test. Now, if we think about it from the other side, look at from the trust's point of view, the trust, where the trustee has appointed income to a beneficiary, it hasn't been paid out yet. There's still a bit of uncertainty about what is that. Is it a debt or a liability or whatever it might be? Well, the ATO seems to be comfortable that whatever it is, it's a liability, and it's a liability that generally does relate to the assets of the trust. And that's quite crucial because with the net asset value test, you start with total assets, market value of total assets. You are only allowed to take off certain liabilities. So certain provisions get taken off, and then liabilities that are related to the assets that have been included in the test. So there's been a bit of uncertainty, I guess, at some points as to whether that unpaid entitlement that is owed by the trust to the beneficiary is a liability that relates to the assets of the trust. Now, in this draft ruling, the ATO confirms that in most cases, probably the default position is that it will be a liability that relates to the assets of the trust. So as a result, it can reduce down the net assets of the trust itself. Now, important to recognise that you might need to look at that a little bit closely because there was a case that went through over the last 12 months or so where a trust had appointed, I think it was capital to a beneficiary, but what had happened then was the trust had borrowed money from an external source in order to pay that distribution. And in that case, the court confirmed that the borrowing from the external source was not a liability that related to the assets of the trust. So there's that distinction there between the unpaid entitlement, which could potentially qualify as a liability, whereas it may be much more difficult for a loan that has been used to pay a distribution to be counted as a liability for that particular test. So a bit of clarity. It's only a draft ruling at this stage, but we'll keep an eye on it to see where things go when the ruling is hopefully finalised in the near future. Our second ATO publication for this month that we'll be looking at is a TD. It's a draft TD 2015/D4. This one also looks around that issue of unpaid entitlements owed by trusts, but in a completely different context. What the ATO is looking at here is where a trust has appointed income to a corporate beneficiary, so a private company, and that private company has released, waived, forgiven its entitlement to receive that distribution. And what the ATO is saying here is that that could be treated as a payment for Division 7A purposes. And if that's the case, that could trigger a deemed dividend. So you would have the income being appointed to the company, which could trigger a liability, tax liability for the company in that year. If the company then waives or forgives or releases the trust from that obligation some point later on, that could trigger a deemed dividend back to the trust, which could be taxable to the trustee or to the beneficiaries, depending on the situation. So it's certainly something to watch out for because occasionally trust distributions do get waived or forgiven. So a bit of clarity again from the ATO just in terms of how they would view it. Now there's a couple of things to keep in mind here. One is if that unpaid entitlement is being treated as a loan for Division 7A purposes, then the ATO basically says don't apply this tax determination to that situation. In that case, you're more likely to be looking at the debt forgiveness rules within Division 7A instead. So you might end up with a similar outcome, just slightly different set of rules, slightly different way of looking at it. The ATO also makes an interesting point that there could be an exception to that position if the trust has lost the ability to actually satisfy its obligation. So let's say the trustee appointed income to the corporate beneficiary, and at some point afterwards, through natural disaster, through a huge share market crash or something, the trust has lost all its money and now no longer has the ability to pay out that distribution. In that case, the ATO suggests that If the company forgives or releases the trust from that obligation, that may not be treated as a payment for Division 7A purposes because it doesn't represent a financial benefit to the trustee. Because the trust didn't have the money anyway, it couldn't pay the distribution, so being released from that actually makes no difference to it. So interesting one. So while the starting point is that that release of that obligation could well trigger a deemed dividend under Division 7A, it will depend on the circumstances. So we will need to look at this pretty closely on a case-by-case basis just to make sure whether we do have that deemed dividend problem or not. Now, this is a draft determination. Again, we'll keep you informed as to where this heads, but at the moment, that looks like where the ATO is going on that issue.
And that's the tax roundup for this month. If you're not a member of Knowledge Shop and you're serious about keeping up with change, then give Julie a call on 1800 800 232 and you can see what membership offers. You'll get access to a knowledge base of standards, a technical help desk, quarterly training, updates, and so much more. Just give her a call and you'll get to experience it for yourself. Talk to you soon.